Breaking news. The Reserve Bank of India just made its boldest move in years, slashing the repo rate by 50 basis points to 5.5%. This isn't just about numbers. Your home loan EMIs, stock portfolio, and even that new car you've been eyeing are about to be impacted. In this video, we break down what this rate cut means for you and how different sectors, from real estate to IT exports, will react. Let's dive in. First, what exactly is the repo rate? It's the rate at which the RBI lends money to commercial banks. Lower repo means cheaper loans, which leads to more spending and investment. It's RBI's way of stimulating the economy or controlling inflation. And today's 50 basis points cut marks a clear policy shift toward growth. This is the second repo cut in 2025, following 25 basis points in February. But this one's aggressive, from 6.5% to 5.5% in just 3 months. Clearly, the RBI sees storm clouds globally and wants to power India's domestic demand engine. Global headwinds are growing. Trump's tariff threats are hurting exports. China's slowdown is pulling demand. Oil above $88 is stoking inflation, and global bond markets are in chaos. The RBI is making its move before things worsen. It's a preemptive strike to boost consumption and credit flow. Let's talk banks. When the repo rate goes lower, lending rates drop too. That's great for borrowers. But, banks start feeling some margin pressure. Net interest margins, or NIMs, actually shrink. But on the flip side, credit demand from MSMEs and retail borrowers is expected to surge, with a growth of about 10 to 12%. Now, NBFCs, which don't take deposits, actually benefit faster from this shift. So, keep an eye on Bajaj Finance and Shriram Finance. Homebuyers, rejoice. A 50 basis points cut means your EMIs just got cheaper. For instance, SBI's rate is already hovering near 7.9%. Plus, Tier 2 and 3 cities may see up to 14% growth in housing demand. And with around 4.5 lakh unsold units across major metros, this rate cut is honestly a lifeline for developers like DLF, Godrej, and Sopa. Thinking about buying a car or a bike? Well, now's the time. Cheaper auto loans, paired with better rural sentiment, really set the stage for a boom. FADA reports an 11% spike in passenger vehicle bookings right after the February rate cut. So you can expect an uptick in companies like Hero MotoCorp, M&M, and Maruti. So, more money in wallets basically means, well, more spending. Rural FMCG sales actually grew by 6% last quarter. And, AC, TV, and fan sales shot up by about 25% seasonally. Now, who are the main beneficiaries here? HUL, ITC, Voltas, and Crompton. Lower borrowing costs really mean that CapEx is making a comeback. With capital now the cheapest it's been in 3 years, you can definitely expect a revival in infra spending. Oh, and the Gati Shakti pipeline stands at a massive 111 lakh crore rupees. Stocks to watch in this space? L&T, JSW Steel, ABB, and Siemens. The rupee is weakening. It's at 86.6 versus the US dollar. That's actually a win for exporters. IT and ITS firms, for example, earn about 60 to 65% of their revenue in dollars. This means a margin tailwind for Infosys, TCS, and Coforge. And, yeah, there's the same upside for pharma and specialty chemical exporters too. So, energy's a bit of a mixed bag, honestly. On one hand, the oil import bill rises, which isn't great. But on the other hand, green energy projects are actually getting cheaper to fund. This is negative for companies like BPCL and HPCL, but definitely positive for Tata Power and Adani Green. Markets won't really go wild, but sectors will definitely rotate. After February's cut, realty was up by about 1.2%, and consumer durables gained 1.3%. Meanwhile, the Nifty was down by 0.4%, mostly because of global jitters. So yeah, you can expect smart money to flow into rate-sensitive stocks, not really into broad rallies. Here's how it helps your pocket. So, with a 36 lakh loan over 30 years, at the old rate of 8.65%, your EMI would be 28,651 rupees. But with the new rate of 8.15%, your EMI drops to 27,446 rupees. That means you save 1,205 rupees every month, which is about 14,460 rupees a year. And well, nearly 1.2 lakh over 5 years. That's money back in your hands. For investing, saving, or just spending. Analysts are calling this the early signs of a credit cycle revival. Growth is back in focus. Question for you. Which sector do you think will outperform? Banks, infra, auto, or maybe IT? Comment below. And hey, are you planning to take a home loan, buy a car, or maybe rotate into new stocks? Let's crowdsource the smartest plays in the comments. That's a wrap on RBI's boldest move since the COVID era. If you found this helpful, hit that like, subscribe, and share with someone who needs to hear this. Until next time, stay informed, stay invested.